Okay, so long-term decarbonisation targets for Australia, we have them at state level. So with individual state jurisdictions, in fact, without exception, have now committed to net zero 2050. And actually the state governments in Australia do have quite a bit of power, decision-making power in the energy sector. So that is definitely an important part of the policy landscape. At federal level though, and bearing in mind that the federal government does control the purse strings around subsidies, taxation, much more so than the state governments do, there is no long-term decarbonisation target. It has been very politically fraught in the discussion, and still is today. We have committed to a Paris target of 26 to 28% reduction in economy-wide CO2 by 2030. And it looks like in our BAU scenario, we will hit that. But the 2050 target, which is obviously much more ambitious than our 2030 target, would require a huge scaling up. There is no political consensus at the federal level as we stand today. Now, our Prime Minister has just been at the G7, and of course there were discussions happening between Biden and Johnson and our PM Scott Morrison, and there were discussions around Australia's commitment to net zero 2050. There's a loose commitment, but it hasn't yet translated into a firm commitment. And the political problems, even after some comments made in the UK at the G7, political problems back home sort of flared up again within the ruling coalition party. So I don't think we can say we've got a political consensus around net zero 2050 at this stage. So in terms of what a net zero 2050 scenario would look like for Australia, we have done quite a bit of modelling in this space. We've got our sort of current policies business as usual reference case, and that sees coal plants closing, at the end of their design life, which is typically 50 years, and we see the power sector decarbonised by 2050 broadly. But then when we look at a net zero 2050 trajectory, that of course being economy-wide net zero, we see the power sector needs to be decarbonised by the mid-2030s, really, because then there's significant electrification which needs to take place across other sectors of the economy to decarbonise the rest of the economy by 2050. And so that scale of demand differences between a net zero trajectory and a business as usual trajectory is orders of magnitude. It's very significant when we look at firstly electric vehicles, so transport and electrification of transport. That alone adds around 80% to the electricity demand by 2050. And if we add on top of that the potential for green export, so renewable exports from Australia, because we have abundant, cheap renewables, and they can be exported potentially in the future in the form of hydrogen, so green ammonia, for example, into countries in Asia in particular that don't have the same natural resources and land availability. And so there's a very significant difference between a net zero trajectory and a business as usual trajectory. And I think the conversation needs to really pick up within industry and government on the difference between those two. The underlying issue or constraint at a political level is this tension between local communities, industrial jobs, particularly in the coal and fossil fuel sector, bearing in mind Australia exports a lot of coal and gas. They're still comfortably among our top 5 exports globally. And so there is this tension between our major export commodities, the jobs that are supported by fossil fuels sector, and I think that then does influence politics just inevitably. And so there are those that support rural communities and regional communities where the fossil fuel and mining jobs are, and they have tended, unfortunately, to question the science and to push back on transition and the decarbonisation ambition at a federal level, and that at a political level has been really hard to overcome. To the point where it's not just a political squabble. We've seen consecutive prime ministers in Australia being removed, with climate politics being the major factor in their removal. So it is quite challenging in Australia, and it's hard to see that changing anytime soon, despite the world and indeed the private sector really moving much more in line with the decarbonisation agenda now, and the state governments. Yeah, so carbon pricing, when I talk about the politics, that's really where the rubber hits the road on the challenges politically. We did actually have a carbon price in Australia before it was subsequently removed by a new government coming to power. The carbon price at the time did actually reduce carbon emissions, and it was the first time in the trajectory of carbon emissions, in terms of actual emissions, had turned down, and that was during a period of strong economic growth as well. So the carbon pricing, however, was removed and very much tied up in the politics, and we had a PM that we lost a PM over that episode, and so I don't see any prospect. Whilst I do see a prospect of Australia committing to a net zero 2050 target, I don't see carbon pricing as the mechanism to get us there. I just don't see that being the policy choice of this government or any government, whether right or left. I just think it's become politically toxic. So the way I see it working is more around subsidy and targeted support and corporate level ambition translating into demand for green energy. And I think we're looking at more like an enduring green value, which would reflect the ambitions of both state governments and large corporates to decarbonise. So they're setting their own 2050 net zero ambitions, and they need to then take action to meet those ambitions. So they're going out to market, increasing the demand for green energy, and that, we believe, is already today creating some residual green value. And so we think that's more likely the mechanism via, for example, RE100 to support green energy deployment. So that's really where our thinking is going, rather than carbon pricing in Australia. So in terms of the green value of these credits that we see in the market today, we do already have a green certificate mechanism. It's related to the 2020 renewables target, which in Australia was a green certificates mechanism. And the certificates are called large generation certificates, or LGCs. And they have some residual value with some carryover opportunities for retailers. It was a retailer obligation. And so there is some residual value in the vicinity of $20 to $30 a megawatt hour as a green value. We see that falling away based on the current mechanism, but that mechanism extends out to 2030. So those LGCs will continue to be traded between retailers and generators out to 2030. And the thinking is that additional or incremental green energy demand could actually reveal itself in the form of demand for these credits. And if the credits were then backed with corporate level recognition and accreditation, then we could start to see the demand for green energy be facilitated via an existing tradable, bankable mechanism that's already in the market. So we do have some tools in place which could be adapted relatively easily to reveal that green credit value. And obviously the value beyond 2030, I mean, if we're looking at a net zero 2050 trajectory, then the whole power sector needs to decarbonise by 2035. So that green value could be quite significant. especially if Australia becomes a net exporter of green energy, which is the expectation. So in terms of the scale of investment, I would go back to sort of the two trajectories that we model for our clients. So the first being the business as usual current policies trajectory, which does not meet the net zero 2050 target. Even under that scenario, we see very significant investment. So 50 gigawatts of investment by 2050 in large-scale renewables, in addition to the rooftop solar deployment, which is in the tens of gigawatts on top of that, and that totaling around 80 billion Australian dollars of investment. So it's very, very significant. And that's without even meeting a net zero 2050 target. That's more like a 4-degree scenario. If we move to a 2-degree consistent scenario or a 1.5 degree consistent scenario, a net zero scenario, then you're looking at 80 to 150% increase in investment on top of those numbers, just to meet the increase in demand for electricity. Now, on top of that, the investment required to decarbonise the other sectors is very significant also. Yeah, and then in terms of who delivers that scale of investment, I mean, that is still open to question really as to what parties can deliver that scale of investment. I guess naturally my mind turns to superannuation funds, pension funds, because there's a high level of savings from everyday Australians in pension funds, and the pension funds have become more active in the sector, interestingly, in the last 2 to 3 years, and there is quite a bit of portfolio consolidation happening with the pension funds playing a pretty key role, taking on long-term renewable risk, more merchant risk. I think the market in Australia is quite competitive already. So we're not missing any category of investor, I would say. We've got private equity, we've got infra funds, we've got pension funds, and now we've got government much more heavily involved. I think the sector is probably now looking to government to start to take the lead, just given the scale of investment and given that the signals for that scale of investment simply will not be there. And what we've seen to date is that the state governments are starting to step up. So they're looking at running renewable auctions, they're looking at underwriting new capacity, they're supporting new storage and getting new business models over the line for storage. And so I think we've probably got a period of time now for the government to sort of set the framework for that next stage in the transition. So for the incumbent utilities, they have, of course, been very key to the first wave of renewable investment. In terms of meeting the 2020 target, they had the obligations placed on them to source renewable energy under the LRET mechanism, but they have not been as active in terms of investment in renewables for the past 5 years. It's really been institutional investors, both domestic and overseas, that have been dominating the investment landscape. I think the utilities still have their customer base, and so they're starting to look at offtake rather than investment. So rather than building their own volumes, they're providing offtake services, and they're focusing more heavily on dispatchable capacity and firming, providing that firming access to the market. And no doubt there'll be more competition for the utilities to provide that service going forward. And for large customers, clearly there is a big push in Australia for corporate PPAs. We have seen a very strong wave of corporate PPAs really for the last 4 or 5 years. And we've gone through the very large off-takers like telcos, the water companies, and we're into the medium-scale corporates that are now coming to market and looking for renewables. So I would say it's quite a mature market, and the corporates are now quite price sensitive or quite sophisticated in terms of the prices they're pushing in the market for their renewables. There's not a great evidence of a green premium or paying above the market value But I think that will change with the net zero commitments that corporates are taking on. So that links back to the green value argument. I think once a corporate takes on that stretch target to hit 2050 and therefore a stretch target for 2030, then they may well have a higher willingness to pay, and that could translate into green value. So I think corporates will be important, but more as an off-taker. I think we'll start to see more demand being met by renewables and contracted directly through PPAs. And then in terms of market and policy interventions that may be required to bring about this transition, I think we probably first need to touch on what's happening in the market today. So we've had a very significant boom in investment in the last 4 or 5 years in large-scale renewables. And in fact, there's no shortage of high-quality projects in Australia. Planning permission is not a key constraint. Unlike much of Europe, we have lots of land and significant renewable resource that can be accessed via the planning regime. But the grid has fallen behind. So we've seen a lot of volumes connected into the transmission system, despite that part of the transmission network being quite weak and unable to sustain correlated volumes of solar output in the middle of the day, for example, and that leading to voltage issues, and then curtailment. And we have seen actual curtailment. We've seen losses build up. So after the investment takes place, after the volumes come in to the market, we have seen investors take a hit with grid issues post financial close. So that's been quite a serious constraint on new investment for the past 24 months. And so we are working through, if you like, a backlog as an industry of investment in transmission to play catch up, to essentially ensure that the transmission is able to accommodate volumes that have already connected. So it is very much catch up. And then the next wave of investment, the idea is, and certainly the market operator, AEMO, is putting forward a long-term plan for transmission investment to be coordinated with generation, so that we don't get further periods of a lack of coordination and grid issues post-financial close, that there's a coordination, that the transmission is there for the generation. More of a build and they will come type approach, if you like. So the transmission is a huge challenge for the sector. The regulatory regime has been a bit slow to catch up, but I think it is catching up now, and I think there are reasons for optimism that the market bodies are now ready to act. On the market rules side, I think there are some interesting developments around development of new ancillary services, ancillary products that will enable the system to run at 80% plus renewables penetration. So looking at inverter-based systems and the inertia requirements in such a system, and then the products required to deliver that service as the spinning plant come off the system. There are discussions around capacity markets in Australia. We still have our energy-only market with spiky prices, which is great at providing signals for storage, but the level of merchant exposure for a storage asset is quite extreme when you consider that prices can rise to $15,000 a megawatt hour in a given settlement period. And so we obviously project those prices out into the long term for the purpose of business case assessment, but it is quite risky for investors in those assets. And so there is discussion around, is the current market fit for purpose for the transition to bring forward the scale of dispatchable capacity required to balance the system, which is renewables dominated. So that'll be an interesting one to watch. And the final one I would point out is the use of renewable auctions or government underwriting mechanisms. We have seen the state governments revert to reverse auctions to bring forward volumes, so CFD type auctions or price floor type auctions, as opposed to additional subsidies in the form of a top-up payment. They're looking to procure the volume, so they know the volume will be there, and then to plan the transmission to accommodate that volume. So again, it comes back to that coordination piece. And I think the industry is catching up on that front. So the government here often uses the words technology, not taxes, to describe its ambition and its approach to facilitating the transition. And really, when they talk about technology, a lot of what they're referring to is hydrogen. There's quite a lot of excitement around green hydrogen and a new export industry for Australia. So they're saying we're going to support technologies, bring the cost of those technologies down so that Australia can bring new products to the world market, rather than impose a tax on the externality being carbon. They're more looking at a subsidised approach.